Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Andrew Cushman. He's a former chemical engineer who found his entrepreneurial calling in real estate. In 2007, Andrew left his corporate position to start a business in real estate investment. He started off flipping single-family properties in SoCal, and then sensing a shift in the market in 2011, he transitioned to multifamily acquisitions. And now he's syndicated and repositioned over 3,000 multifamily units. So Andrew, thank you for being on the show.
I'm glad to be here, Ken. Appreciate it.
Well, let's start at the top like we always do, and let's help others understand a little bit more about who you are and how you got to be where you are today.
What you just said is pretty much the gist of it. I took the standard path into real estate and got an engineering degree, which seems like about half of us do. And then we realized real estate's actually more interesting and more rewarding. My wife and I both had regular jobs, and we were looking to exit that. We found the flipping, as you said, and then after the great financial crisis, which didn't feel that great to a lot of people, but after that. So, hey, we had a huge recession. That means we're probably going to have a large economic expansion. And large economic expansion means job creation, household formation. But everyone just got foreclosed on and they can't buy a house. Or they know someone who got foreclosed on and they're scared to buy a house. So, okay, job creation, household formation, rising incomes, no one's buying houses, rentals. And so that's why we got into apartments in 2011. We went and found a guy who had done 800 units because we were looking at things, okay, this is scary. These are big buildings. So we found someone who had already done it, hired him as a coach. Our first one was 92 units out in Macon, Georgia, and I live in Southern California. And like you said, a little bit over 3,000 units. Been a great business since. We're very fortunate to have gotten in at the start of that huge cycle, and I feel like we're about to start another cycle now. It will not be as amazing as the last one. That was an anomaly, but that doesn't mean it's not a good time to be getting in.
Yeah, interesting. So you started in single family. You started really flipping, right? And you saw that shift as GFC. I mean, obviously, housing prices went down, everything changed. Right. And that's what sent you into multifamily. You saw rentals as the future. That was a great call in 2011, right? Because all things did until 2022 was go straight up.
Yep.
So sure, a lot of success through that period. Now that you've kind of been through the GFC, you've been through that period, you've now been through kind of, COVID, inflation, everything that's happening right now, looking back on kind of 16 years in the game here. I'm curious as we dig into this, kind of some of your insights, some of the wins, some of the lessons learned, and then really what I want to dig into is like, how has it changed your perspective on how you're doing things now, and help our investors understand what they should be looking for now versus maybe what they should have been looking for in 2011 or 2022. Right. And so we're kind of step through that, but let's start with, what are some of your biggest lessons learned as you look back now in multifamily that are kind of driving how you do things today?
There's a lot. I'll give you three right off the bat. So number one is, and this is more on the business side, but I should have hired more people and expanded our team earlier. I did too much by myself for too long, which is kind of an entrepreneurial trap that we all get into. The second one is, at a certain point, I don't remember what year this was. Maybe it was 2016 or 17, somewhere right around there. We kind of looked back at what we had acquired and operated so far, and we realized that, it's really tempting because it's cheaper, they're easier to get for new entrants into the multifamily space, or even sometimes single family, to go for those kind of lower end C-class properties. And what we realized is, you look back at the portfolio, the properties that not only provided the best returns, but also had the less headache and the lower risk were actually the Class B stuff. So that was a pivot we made. I'm going to call it maybe 2016 or 2017 is kind of away from the heavier value add Class C, because some of the first things we bought were rough. And then we moved more into Class B, and that's where we are today, B minus to A minus. And then kind of dovetailing on that, in fact, the worst deal that we've ever done was a rough sea property in a very rough part of South Dallas. We didn't lose money on it, but it definitely didn't go well. And then the other big lesson is it's really tempting in real estate or just business in general to land on a thesis and just kind of structure everything around that. Well, I think interest rates are going to go down, so I'm going to underwrite that way. I think interest rates are going up, so I'm going to underwrite that way. And so rather than doing that, the key is to think probabilistically. Say, well, okay, I think the most probable outcome is interest rates are going to do this. But what if they do the opposite? Is there a reasonable chance of that? And if so, how does it affect me? So how that plays out in the real world is in 2021, which is was just leading into the peak of the multifamily market and all the hype and the excitement that came to an end after the beginning of 2022. Is we were buying a large property in the Florida Panhandle, and we were looking at fixed rate agency debt, and then we're looking at, of course, most people at the time were getting floating rate debt, and the floating rate debt was a good, point or point and a half cheaper, which means the immediate cost of your debt is a lot less. We would have ended up with like a 2.5% rate, but we looked at the deal and said, well, we want to hold this for at least 6 years. What could make it? What could kill it? What could make it collapse or go wrong? And at the time, like everybody else, we believed interest rates would go up, but we also believed, like everybody else, that it'd be a slow process. And that's our base case, was a slow increase in interest rates. But when we looked at it, we said, well, what if that's wrong? What if interest rates dramatically shoot up or the economy changes? Then we could take a bad deal, a great deal, and it could turn into a bad deal. So we said, you know what, let's eliminate that risk and fix the debt. So we got a 12-year loan locked in at 3.79%. We still have that loan today. That property cash flows like crazy. And it's not because we saw this coming. We did not see this coming like anybody else. I didn't know that the Fed was going to come in and quickly jack up rates 500 basis points. But what we did do is we saw that as a non-zero risk, like there's a non-zero chance that could happen. And we said, well, that seems unlikely, but man, if that happens, we're done. That's like the whole thing collapses. So we said that's not acceptable, eliminated that risk by fixing. And instead of giving that deal back to the bank today, it's in really good shape. So that's think probabilistically. Don't get trapped in a case and say, okay, well, I'm going to structure everything because I think this is going to happen. Well, what if it doesn't? So.
Yeah, I think those are great insights, right? And we could dig into a little more, but you just talk about your operations and, hiring faster, right? I mean, that is something that I think a lot of entrepreneurs get trapped in. The move from C, and it sounds like even like C, but like rough C, like heavy rehab.
Yeah. That is a good differentiation. I mean, and don't get me wrong. I've got a friend who specializes in rough C. Like that is his thing. And he knocks it out of the park, but it's a high headache, high risk game. He can do it really well because that's all he's done. So he does that's why he does well. But for most people, just realize if you're investing in that either actively or passively, it is a higher risk game and should have higher returns.
Yeah, and then I love this idea of think probabilistically. Because I think it's easy to you get stuck in one way of thinking, or you're hearing one thing in the headlines, right? And everything's always presented as like, this is absolutely going to happen, right? It's either the worst thing or best thing ever. But this idea, there's a lot of gray area. Yeah, there's always this gray area in between, and how you think about that and how that helped you really look like a genius now coming through what's happened in 22 with interest rates coming up, right? And being in that low rate loan, that feels really good right now for you and your investors. So I think a lot of good lessons to take away from there. One thing to hit on, I'm curious. So what you're kind of saying in this B space is that this is your best risk, what I would call risk adjusted return, right? You're saying it. Yeah. And so I'm curious, as you dig into that and talking about the evolution in your mindset from these rough C's can really look good on paper, right? High cap rates, man, if you turn them around, they can really do well. But when you're evaluating the deal and taking it from what could be on a spreadsheet, right, to reality. What were some of those tough lessons you learned? And then kind of moving into the B space, like how does that mitigate a lot of that risk?
Yeah, you nailed it. There's a big difference between performance on a spreadsheet and performance in the real world.
Mm-hmm.
Execution is everything. And so, like going back to that property that big property in Dallas, number one, older C-class properties are typically older, sitting 1970s or 60s and older than that. And so generally speaking, the older the asset, the more stuff is just falling apart. And it's the expensive stuff that you don't get rent increases for. So like the plumbing, you often looking at all kinds of plumbing issues, electrical. A lot of times the AC is failing. You might be replacing roofs, replacing siding. And these are all extremely high dollar repairs that under correctly residents just assume are going to be functional. No one's going to say, oh yeah, I'll give you $200 more rent just because my plumbing works. Like no, that's table stakes.
Mm-hmm.
So there's that aspect. The second is when you're dealing with a resident base that in general is very paycheck to paycheck, hand to mouth, and especially these days after the effects of inflation, struggling to make ends meet, you have a lot of difficulty with collections and delinquency, people not paying, not able to pay. They're doing okay, then they get a flat tire, and the cost of fixing that just disrupts everything, and now they can't pay rent, they get behind. So collections is much harder, so you have much higher effective vacancy. And then also you tend to get a higher percentage of people who are just much rougher on the units. It's not like, hey, they move out and it's nice and clean, we'll touch up the paint and release it. That was one of the lessons we learned on the property in Dallas is we did a renovation. We bumped the rents $200, moved someone new in, and 6 months later they'd stop paying, and then we'd have to evict them, and they'd destroy the unit when they left. And it wasn't just turn it, like we had to renovate it again. So the operating costs are much higher. Effective vacancy is much higher. Delinquency is much higher. And there's just admin is more difficult. And so that's part of why the difference between spreadsheet and real world is because on a spreadsheet, it's really easy to be like, we'll put in 10% effective vacancy. It's probably actually going to be higher than that. Same thing with recurring repairs, recurring capex, and all of that. Again, not to say Class C isn't, everyone should just avoid it and it's not profitable, because that's not true. It's a higher risk, higher reward game, and higher headache. So we've kind of moved out of it, and you used the exact term risk adjusted. When we found that class kind of B minus to A minus for us had the right blend of good return, but at a lower risk with less downside.
Mm-hmm. Yeah, and that makes a ton of sense. And so, and what is it then about this space you're playing in now that has allowed you to have kind of less headaches, but still decent returns? So, talk about kind of that sweet spot that you seem to have found.
Yeah, so I'll talk about the deal that we closed on April 10th. Stabilized property, so like 96% occupied. The owner is a professional owner, so it was well cared for. It was built in the 90s. However, this particular owner, he takes good care of the properties, but he's not into like upgrading or doing anything like that. So over the like 6 years or so that he had owned it, the rents had not kept up with market. And so it was actually, $500 to $600 below the nearby comparable properties. It had a fixed rate. He had already put fixed rate financing on the property. So it was locked in for another 8 years. We know exactly what the debt's going to be. And so that was a good example of what a good risk adjusted return, because when we bought the property, we closed on it, it cash flows from day one. Like if we completely fail to execute our value add program, the property still cash flows. Now, it wouldn't hit our pro forma, but we're not in a situation of distressed asset or losing people's money. So that's again, minimizing the risk. The second piece we already kind of touched on, we know exactly the terms of the debt. They're not going to change. It's already locked in for the next 7.5 years. So that eliminates that. Also, was fairly low LTV. And then being Class B, it tends to appeal to a demographic that has just a little bit more disposable income. So delinquency tends to not be as bad. So again, if someone gets a flat tire or has a medical issue, they can still make ends meet and still pay their rent. But with all of that, we still had significant upside by saying, hey, if we spend, I think it was $13,000 a unit overall and improve the property, then we should be able to get rents up significantly higher. And the first batch of units that we renovated, we actually were able to achieve that. So that's an example of the first question you should always ask is not how much will I make or how much are the returns going to be. The first question should always be, how could I lose money? How could this go wrong? And so you address all of those first, and then, and only then, if you get to a point where you feel like there is either very little downside risk or you can mitigate it, then we start looking at the upside, and we felt like this has significant upside. So minimal downside, good upside, and that makes for the kind of deal we'd want to do. And that's really hard to find. This was only the second deal we've done in, I want to say, almost 2 years after looking at something like 1,000 of them. So
So what you're saying, and what I'm taking away from this, is like really what you've moved into. I mean, while there's still decent upside, it's really more about that downside protection, right? And that's really what you're focusing on. And a couple ways you've done that are, I think, great things for investors to look for, right? So one, the fixed debt, right? Debt that's controlled and debt that is not a variable, right? It's not going to move up on you and happen what happened to a lot of folks in the last inflationary period, right? So you're removing that interest rate risk, right, is one big one. And then the other thing you mentioned is the property's cash flowing from day one, right? And I think that's another way to really eliminate a ton of risk, because if you're starting in a position where you're going to have to fund operations at the beginning, right, that's a completely different risk profile than a property that you said was built in the 90s. So, I mean, I'm just imagining this, right? This property's maybe been there for 30 years. It's been a business for 30 years. It's been performing, it just hasn't been producing as much cash as it potentially could, right? But it already is producing cash. And so it's unlikely that business completely falls apart. And I think that makes it a much more stable investment. And that's what you're describing as kind of that sweet spot. And I think two great takeaways for investors to look at: fixed rate debt and a property that is cash flowing out of the gate really lays off a lot of the potential risk.
Yeah. And it's not that floating rate debt is 100% never ever touch it. It exists for a reason, but it was misused greatly the last few years, and not taking it just eliminates a lot of that risk. So
for sure. Absolutely. So, a lot of things you've learned as you've gone through this. I'm curious now, as you've shifted, right? And we've come through and we are where we are now, and you've been through kind of a cycle or two. And, for our investors who are trying to evaluate deals, right? They're trying to say, is this a good deal? Should I invest in this deal? What's some advice you can give them? How has your thought process changed as you're evaluating deals? Like, what are things that you're doing differently now that you were doing 5 or even 2 or 3 years ago?
It's funny. If I really look at it, the truth of the matter is we're not underwriting that much differently, because the fundamentals of underwriting and evaluating a deal don't change. And that's part of why, like I said, I think it was in 2022, we went like 18 months without finding a deal that we found was acceptable. Now we're starting to find some. And so rather than adjusting the underwriting, what happened is we got into a period where we rarely did deals for almost like 4 or 5 years. It was just like one here, one there, because the fundamentals of underwriting don't change. But, in terms of trying to specifically answer the question, these days, we have moved our hold time just a little bit longer. We used to kind of target like 4 to 5 years. and now we're more five to six, just to give it a little bit more runway, a little bit more, time on the debt, just to make absolutely, that's one of the beautiful things about real estate is time is almost always your friend. Like if you look back at the great financial crisis, people who bought houses at the peak and then things crashed down and like, oh, we're never going to get back to that. Well, actually, if you had held all of those houses, they would be worth more today, right? Mm-hmm. Might not be the best investment you ever made, but the point is generally speaking, in the United States, for the last 100+ years, and this should continue, because of the devaluation of the dollar and inflation and all that, the nominal value of real estate goes up. So time is your friend. And so we've extended timelines just a little bit just to make sure that we were never forced to do something in an adverse market. That's one. We are still underwriting to cap rate expansion, which means we are expecting, we underwrite as if the market is going to be less favorable when we sell than it is today. I guess that's probably might be a good way to explain that. Just trying to think, but again, the fundamentals haven't changed. Make assumptions that are realistic, right? So you could make a drinking game out of people going on podcasts and saying we do this conservatively, right? And every time the word conservative is used,
you'd be drunk pretty quick. Yeah,
you wouldn't make it to the end of a 25-minute podcast. So thankfully I don't drink. Otherwise, it just wouldn't happen. But so the question is, no one defines what that means. So what that means to us is we are going to underwrite to whether it's rent growth, vacancy, delinquency, all of the things that you put into underwriting. We say we want to use a value that we feel has at least an 80% likelihood of happening, right? So, for example, if we're in a market where the forecast is for 4% rent growth every year, we're going to underwrite 3%. Because, if the forecast is 4 and they're wrong, there's a reason that was at 4, right? So it sounds like we're probably really likely we're going to at least hit that 3. So that's that. So that's what that looks like in real life, stuff like that. Or okay, so market vacancy is 5%. Well, let's underwrite to 7, right, or 8, or something like that. So.
Yeah, I mean, that's really similar to how we look at it. Honestly, it's kind of this 80% threshold, which is interesting that you said that. Because, I mean, that's what it's, if you can be 80% confident that that's going to occur, and you're laying off a little risk in that way by being more conservative on the front end, I think you're setting yourself up for like what I'll call a lot of ways to win, right? Yeah. In any deal, you want to have a lot of ways to win. You want to have, okay, maybe we could beat it on rent growth. Maybe we could beat it on the renovation premium. Maybe we could beat it that renovation costs a little less. Maybe we could beat it that cap rates do a little better than where we think they're going to be, right? But there's a lot of ways to win in a deal. And that's something we fundamentally are always looking for, is like, we don't just want our business plan to be based on one thing going right.
You know what? That's the perfect, concise way to encapsulate that. I think I'm going to borrow that from you. I'll give you credit the first time, but but that's what it boils down to, is you're looking for deals and operators, and this applies to everything, where you have lots of ways to win and very minimal ways to lose.
Yeah, and that's well said. So as you are, you're looking at now, so it sounds like, look, your underwriting maybe didn't change so much. It sounds like you held pretty firm, and because of that, you just didn't do deals for a while. Yeah. Because the market just wasn't aligned. I'm curious on the cap rate thing, because I think this is, a lot of people have a lot of opinions on this right now, because cap rates have expanded quite a bit, right? And so cap rates have expanded. They're much higher than they were. I mean, I don't know how far you need to go back, maybe 10 years to kind of see where a lot of them are right now. Even in that environment, you still underwriting expansion, or kind of what's your general thought on kind of where things move? Probably getting into your probabilistic thinking, right? But I mean, you're still underwriting an expansion, even thinking that's your thesis from here, or how are you looking at that?
So the short answer is if I look out 5 years, I have no stinking clue where interest rates or cap rates are going to be that far out. I mean, 6 months from now, we're all going to be wrong, right? So I kind of look at it and say, well, again, getting back to what could what could make this not a great deal. And it's interesting. One of the, if someone wants to tweak a spreadsheet to get to a certain return, the easiest lever to pull is exit cap rate, right? If you get an
That's
exit
true.
cap at a 6, you're like, oh man, this is only showing a 13 IRR, and my investors want to see a 15. Well, you go drop it to a 5.5, and dude, you got a 15.8, right? Like, I mean, it's that big of a lever. I don't think most people realize it's one of the biggest levers is what you assume for an exit cap. And so, yes, cap rates have expanded. My base case for where cap rates go, if I were to assume is the most probable, and I do not say this with high conviction because, like I said, it's so much going on right now. I would guess cap rates for multifamily probably stay in the short term flat to maybe down a little bit. And then over the longer term, it's going to depend on inflation and interest rates and kind of the economy. So as the further out we go, the greater the risk I see of divergence of they could curve back up or, possibly coming back down. And then everybody focuses on interest rate. What's the interest rate and what's that going to do to cap rates? That's actually not the right thing to be focused on. It's important, but what determines cap rates more than interest rates are capital flows. What a cap rate really measure, I mean, I'm sure your listeners are familiar with the math of a cap rate, right? Like NOI divided by, purchase price, blah, blah, blah. And that's set up that way for a reason. So basically what that is designed to do is it's designed to show how the capital markets value an income stream. So getting back to the riskier Class C, they trade at a higher cap rate, let's say 8%. Well, what that says is that capital sees the risk in that Class C and therefore demands a higher cap rate, where a Class A might trade at a 4.5% or a 5% cap rate, which means technically lower return, but capital sees the lower risk and says, well, I don't need as much return because I have lower risk. And so what cap rates, when we say, cap rates moving up or down, what has the greater impact on that, even more than interest rates, is market liquidity and demand for return. So right now, there's still trillions of dollars of liquidity sitting out there in money market funds, waiting to be deployed. So there's a good chance that'll drive cap rates down a little bit in the short term. In the long term, who knows? It really depends on capital. I think, again, base case is at least for the next 5 to 10 years. The United States and U.S. real estate is going to globally remain one of the most preferred investment classes, and that capital demand will help keep cap rates from accelerating too far upward.
Yeah, I tend to agree with you. And the nuance of it is driven by capital flow that is, I think, often missed. I mean, one of the biggest indicators or dictators of capital flow, right, is interest rates. So they're kind of highly correlated, but yeah, if we're going to nerd out on real estate for a second, that is kind of the true, driver of it. And so, but as you think about that, I love the comment on there are trillions of dollars sitting in money market accounts, or even just with private equity firms and other firms that just have not been deployed because of the environment we've been in. I think one of the biggest drivers, as you think about one investment versus another, right, as interest rates come down, which, I mean, they likely will some, that those money market accounts, those bond accounts, those things become less attractive. And again, it kind of shifts the demand for other type of cash flowing assets. And so, which I think we saw a lot of, right, when interest rates were zero in the short term, right? We saw a lot of demand for the cash flow. And so I think it will be an interesting shift. I appreciate the insight on cap rate. I thought that was well explained for our investors that don't know what cap rates are. That was a good kind of intro to it. So I appreciate that. And with Andrew, I think that's a great way to kind of wrap up our convo before I bring you into our keys to success round. And I got 4 questions I want to ask you before I let you go today. And the first one is, so put yourself in the place of one of your investors, right? And you don't know anything about the deal. So it couldn't be one of your investors because you're going to communicate well on the front end. But let's say you don't know anything and you got to send this check. What is the one question you're going to ask that deal sponsor before you make your investment?
Oh man. I mean, the truth of the matter is, there's probably about 150 questions you ask him, but I say one very revealing one is tell me about the worst deal you've ever done, what the results were, and what you learned from it.
Yeah, I love that. I love the track record. I love the do they admit there's been a bad deal, right? How do they take accountability for it? There's a lot that you can unpack from that. So I think it's a great response. Second question is, what are you most proud of in your career?
If we're focusing on career in business, it would be that we've never, yeah, we have had deals that did not go as well as planned. I already mentioned the one in Dallas a couple of times. No deal ever hits pro forma. You either, that's because that's a 5-year guess. You're either above it or you're below it.
Mm-hmm.
So we definitely have had some deals that didn't go as well as we hoped. However, we have never lost investor money in a syndication, and that includes all of the deals that we've done over the last 5 years. It's easy to say that from something you bought 10 years ago because the
Mm-hmm.
prices were so low. But that includes all the recent stuff. So our entire portfolio today is cash flow positive, is making distributions to investors. Again, some of those properties, they're not where we hoped they'd be. Like we've got some in Atlanta that, rent growth went negative. But again, because we hedged the downside, they're still doing okay. They're making distributions, just not what we thought they would at this point. We still
Mm-hmm.
think they're going to get there. So I'd say that's probably one of the things I'm most proud of, because it was really frustrating for several years. Like, dang, how come everyone's doing all these deals and we can't find any? Like, are we doing something wrong? And it feels good to be validated that actually no, we now have, everyone had FOMO. We now have what I call JOMO, or the joy of missing out. Meaning we have the joy of like, oh man, we didn't end up doing any of those bad deals. So yeah, we're really proud of that, and we've kept our entire team because we're the property's cash flow. We can pay our bills without doing deals, so we've never laid anybody off, and we're in a good position to take advantage of the next cycle. So.
Oh, good stuff. Definitely something to be proud of there. What is one book that everybody should read?
How to Win Friends and Influence People. It's an old book, but it's really a study in human nature, which does not change, and it applies to every single aspect of life. I mean, huge applications in business, but really across the board. Like if you want one book that you can use to improve everything you do, it's that one.
Yeah, I love it. Great book. I think something everybody needs to revisit every couple of years, probably.
I
Right
do. I have it highlighted, and my goal is once a year go back and review all that. So.
there, you go. Last question for you, Andrew. What is your number one key to success?
Let your yes be yes and no be no.
Explain
Meaning,
that. Yeah.
yeah, it goes back to, if the people who are trustworthy in the little things are often trustworthy in the big things. So if I say, Ken, I'm going to call you Thursday at 3. I mean, how many times has someone told you that and then they don't call, right? And it's like, oh, sorry, I had this thing come up or whatever. Well, if I tell you I'm going to call you at Thursday at 3, I'm either going to do it or I'm going to reach out ahead of time and be like, hey, man, I'm really sorry this thing came up. Can we reschedule, right? Yeah, life happens, right? It's just, but it's, so be trustworthy and consistent with all of the little things, so that you build that, and it builds the habit of being trustworthy with the big things. And also, you should never have to say, I promise. Now, that's what that kind of gets to the heart of it, because if your yes is yes, meaning if you say, yes, I'm going to do this, or no, I'm not going to do that, then that's good as an ironclad promise, just because you said it, right? Let your yes mean yes and your no mean no. Yeah, I'd say that just doing that, because especially if you're using other people's money to invest, that's, as we're starting to see, absolutely critical.
Yeah, I like that. I haven't heard that one before, but it makes complete sense. And do the little things well. I did hear a similar quote. I can't recall where I heard it now, but I've said it a couple of times since. Was like, basically along the lines of like, and it's really hard to differentiate yourself on the big things, right? Everybody says, to your point, everybody says, oh, we're conservative or whatever, we're transparent. It's the little things where it's easy to differentiate yourself, right? And just building those little things up. I mean, that's really truly how you differentiate yourself over time. And so I think
exactly right.
similar type of mindset there that I've been kind of holding on to the past couple of weeks. So appreciate that. Appreciate you sharing that. And so, Andrew, if people want to learn more about you, want to learn about your business, what you're investing in, how can folks get a hold of you?
Yeah, I'm not a social media guy. So the only platform I'm on is LinkedIn, but that is actually me posting. And if you comment and get a reply, that's me replying. It's not a virtual assistant or an AI bot. So LinkedIn is great. So please connect with me there. And then our website is, it's Vantage Point Acquisitions. If you search that, or as my kids would say, if you search it up, it comes up. We got pretty good SEO somehow. So, but the actual website is vpacq.com, and there's a bunch of information on there and a couple of tabs for a couple different ways to get in touch with us.
Excellent. We'll make sure it's all listed below so folks can get at you either LinkedIn or through your website. And with that, Andrew, hope you have a great rest of your day.
All right. Appreciate it. Good talking with you.